Hi, everyone. I'm Gary Brode from Deep Knowledge Investing. Welcome to the meeting of the Board of Advisors. The most common question that I've been getting from people is relating to the market. Everybody's asking the question, hey, the market's at all-time highs. We're worried about the coronavirus. We're worried about the economy. We're worried about tens of millions of people unemployed. We're worried about people being able to pay their rent, their car loans, their mortgage. There's political risk. There's economic risk with trade relating to China. How can the market be at all-time highs, and how can we invest in this environment? The answer is it's tricky. This is something Raji and I discuss on multiple times a week. And the quick answer is all of those concerns that each one of you have listed to me are legitimate concerns. And these are things that worry us. And what we've done is what we've always done. We have continued to invest in high growth companies and also recovery companies where the stocks are trading like they're going to go out of business, and we think they won't. We are short the market, which means we're implicitly long high performing, high growth and recovering companies, and implicitly short the part of the market that's not doing well. Before we go to Raji to talk about the exposures that we're looking at and how we're thinking about it, I just want to address one other question that we're getting. People keep asking, with all those concerns, how is the market at all-time highs? Obviously, everyone has their own answer. We're focused on two of them. One of them is the Federal Reserve. As a reminder, between Congress and the Fed, they've fired close to $10 trillion of stimulus into the economy. The Federal Reserve has gone far beyond their mandate, and they are buying corporate bonds and junk bonds that they are not supposed to be able to buy. There are rumors they're going to start buying equities. They haven't done that at this point, but price discovery in the market is broken, and that's part of what's happening. The other thing that's happening is when people say the market is at all-time highs, how can this be? The answer is sort of. So the S&P 500 is at all-time highs, but we're going to remind you that it's a cap-weighted index. And what that means is that the 5 or so FANG stocks make up 25 or 30% of the index. What we're seeing is a very small number of companies that are performing well, that they're mega cap companies dragging the whole index up, while more than 50% of the index is down. And that implicitly is the part of the index that we are short. So while the index is up, that doesn't necessarily mean all the stocks in the index are up, and there are a lot of them that are performing poorly. What I'd like to do is bring Raji into the conversation right now. And Raji, can you talk to people about the industry exposures that we're focused on right now and how we've been thinking about this?
Sure, Gary. Thank you for organizing this. It's nice to meet you guys all on Zoom, for the people who I haven't met before. The number one question today is, the market and where it is and how can it be where it is, and confusion about it. So before I get into the exposures, I just kind of, because the way in which we construct the portfolio, both alongside and the short side, doesn't have much to do with the market per se. I mean, the market is a collection of different sectors. Some sectors like retail and banking have done very poorly. Some sectors like cloud have done very well. And when you see the overall market exposure, you're really getting sort of a blended view of everything. And people look to the market to reflect sort of the economic outlook. And our belief is that there isn't much connection between the economic outlook and the market. The market is more tied to the credit markets and Fed policies. So I'm going to get into the exposures in a second, but so we kind of think of the market and the exposures where they are today as an assessment of risk. One of my favorite quotes in the world is a quote from Voltaire, who said, "Uncertainty is an uncomfortable position, but certainty is an absurd one." And that's the challenge really that people face. Gary and I, one of our favorite statements or responses to questions about the market or the economy is, we don't know. We don't know. And the reason we don't know is the data set, the information flow, the events that are going to determine where the economy is in 2 or 3 years may not have happened yet. It's an evolving process, and anybody who tells you with certainty we're going to be in a recovery or not a recovery, you have to call into question that judgment. So if uncertainty is the issue and risk is the issue, the market tells us more a sense of where risk assessment is. Everyone knows the economy is in a precarious position, right? I mean, anybody who's traveled goes walking down Fifth Avenue, seeing stores boarded up, social unrest. Things don't look good right now, and yet the market is now up on the year and on all-time highs. If I told you we'd have 30 million unemployed, a pandemic that killed hundreds of thousands of people, and a virtual shutdown of the U.S. economy, and we'd be making new highs, you'd laugh at me and say I was crazy. But that's where we are today, and that's not where we were 3 months ago. So the challenge that Gary and I have found in terms of assessing this is there's two levels of risk here. And this comes from sort of capital markets experience, and went into our thoughts on how to construct the portfolio. There are, back in March and April, the world was ending, the market reflected that. S&P was much lower, the markets were much lower, and the credit markets were in disarray. Today, it's the opposite. The valuations and where the market is discounts a full recovery. So the reason we've done a balanced book, long and short matched up, is because of that dichotomy between the market and the outlook. We are able in our concentrated format to find undervalued securities, but the backdrop for investing today isn't particularly interesting because we're not getting paid for risk. You'd rather buy into a market at uncertain time. You want to be offered discounted pricing for that. When things aren't going well, you expect a discount. That's not what we're getting today. So as Gary said, we focused the portfolio on areas that are doing well. So if you look at our exposures today, we're about 80% invested in what we would call the growth stocks. So today we divide the market into 4 areas. Growth stocks, which are companies that are growing irrespective of what the economy is doing, where there's a secular long-term transformation or market expansion. Things like cloud computing, things like security, online shopping. Then there's the recovery trades. These are things like airlines, casinos, retail, that are where the stocks, the sectors have gotten quite punished, but there's a recovery trade. If the economy gets better, those stocks should do well. And then there's the defensive sector. These are things like food stocks and REITs and things that should largely buffer you from the market today. If you look at our exposures today, we found opportunities in the growth sector, and we're 80% long growth and 20% short along the recovery trade. Sorry. So heavily weighted towards growth. These are companies that we found that are doing well in the current environment, where the coronavirus may have actually helped them. One of the big transformations going on in the economy is the implementation of many technologies in terms of cloud, security, mobile computing have gone from sort of a 2 to 3 year expected window and been compressed into a 2-month period. So we're actually seeing our companies in that sector do quite well. The backdrop to being invested in those companies is not appealing because the overall market is questionable. Where the market is today discounts a very, very rapid recovery. And like I said before, Gary, I don't know if there's going to be a recovery, but that is the discounting factor in the S&P today. And that leaves us not very comfortable with the market levels given the plethora of risks that we see out there. So to hedge that risk, we've structured this portfolio where we're long. But because we acknowledge the risk in the overall market, we've hedged that out. Effectively, we've shorted out the market risk and we're exposed to the individual company's performance. And they were matched up long and short, where historically we might not have been. Let me pause. That was a long-winded answer. So,
does someone want to pop in with a question on that or need a recap? Raji, just so you know, your audio blipped out a little bit. The summary of it is we are long a bunch of companies that are performing extremely well on a fundamental basis, where the coronavirus and the various lockdowns have actually helped those companies. Amazon is a great example of that, where people, instead of going to retail, are ordering online. That's 80% of the portfolio. 20% our recovery stocks, things like Raji was talking about Las Vegas Sands. We've looked at the banks at times. At various times, we've been involved in the cruise lines. Those are all businesses that are performing poorly, but are trading like they're going to go out of business. We think things will get better. That was a summary. If someone has questions and wants to pop in, that's great. If not, Raji, I think what would be interesting would be to talk a little bit about the industry exposures of the portfolio.
Okay, I'm just sorry, it just dropped off. I'm pulling it up. We're basically, if you look at our exposures, we're about 40%. Sorry, let me pull them up. I apologize, guys. Just dropped my connection. I'm in a hotel in Miami in the hotspot, and we have intermittent internet here. So if you guys can hear me. So here are the actual exposures. If you look at our exposures, today, the internet exposure is about 48%. We call general tech and media is about 11.7%. We have a unique position in Starbucks, and then the recovery trade, which is mostly banks, and a small position in the airlines, which we've put on very recently in the last couple of weeks, represent about 20%. So again, we're long 80% growth, which is what I would call tech, internet, and then the Starbucks trade. And against that, we're short what's called the RSP, which is an equal weighted index of the S&P. And the reason we're doing that is, you know, one of the points Gary made initially was if you look at the market, you take out the top 5 stocks, it's done very poorly. In fact, if you just buy the top 5 stocks, that seems like all you ever have to do. But if you exclude them from the index, the S&P is actually done quite poorly and is negative. If you're in the S&P, it's a weighted index. So you're effectively short large tech companies like Amazon, Google, Microsoft. And we didn't want to be short companies we were exposed to on the long side. We want to hedge out the weaker companies. So the RSP is a more interesting vehicle to do that because it makes us more net long growth in the portfolio when we hedge against it.
Right. And so for what it's worth, we are overweight the growth companies that are part of the index that we're shorting, and we have no position in the poorly performing you know, retail sector or the automotive sector or any of the other sectors that the real estate sectors that have been doing poorly during this. So we're implicitly long the fundamental high performers and short the fundamental poor performers. The one thing that I would add to what Raji was saying is we're also long HCA. You guys saw the report out yesterday. That's more of a special situation titled Heads I Win, Tails I Win. Basically, the hospitals are positioned, or rather HCA in particular, is positioned to do well regardless of what happens with the virus. And they should be more economically insulated than some of the other companies. Raji, did you want to go a little longer on some of the hedging strategy on this?
Yeah, look, you know, the hedge is about risk. We're hedged today because we don't like where the market is. You know, the Fed interactions and the fiscal stimulus from the federal government have basically broken down the pricing mechanism in the market. And that happens in every recovery. It happened in 2008, 2009. And you get this flood of liquidity into the credit markets. That stabilizes the credit markets. So let me give you an example. You know, you can buy high yield bonds today that yield 2.5%, 3%, or you can buy stocks that yield 3 to 4%. The Fed move is pushing people into stocks. It stabilized the credit market, and the credit market, in my opinion, usually leads the equity market. So where the market is today, you know, there's an old saying that if you want to know where the credit market goes, equity market goes, follow the credit market. If credit spreads are blowing out, that's a worrying sign in terms of where the stock market's going to go because it's assessing economic risk. That doesn't exist today. If anything, the economic risk is quite high, and yet credit spreads in the market are as low as they were when times were booming, and that's artificial. So we've got this artificial environment that's very macro oriented. So if you think of markets, they can be either macro driven or micro driven. A micro driven market is one where there's GDP stability. It doesn't vary very much. And the performance of the overall index is a function of the individual performances of the companies. It's where we say company specific events and developments and news flow affects where the market goes. A macro market has very little to do with the individual company performance. It's much more tied to macro developments in terms of the Fed, tax, election, things like that. And that means that our individual security analysis breaks down. So Gary likes HCA. He thinks we think HCA is undervalued, or we think Las Vegas is undervalued. And that's a special situation, but we're at a point in the market where we've got a breakdown in sort of the risk pricing mechanism, and we're not comfortable. So those considerations drive the hedging decision. And maybe a more simple and better way to describe it is, imagine buying a great house in a bad neighborhood. It's not the same as buying a great house in a great neighborhood. When you try and get out of the bad house in a bad neighborhood, you're not likely to make money. Today, buying a good stock in the market, think of the market as a neighborhood and the company as your house. You find a great house, but the neighborhood stinks. So, today the environment, the overall market environment is not really compelling, and there's a lot of things to be concerned with. That's what drives the hedging. It's, some funds run different strategies where they do pair trades, or they short because they know the world's going to end. We don't know that. What we know is today the level of the market is it discounts a very rosy outcome, and we don't know. We think the likelihood is it's going to be less than rosy. And even if we buy great companies and the market goes down, those companies will go down with the rest of the market. So given the risk factor in the market today, we're not comfortable being net exposed to it. So we're trying to hedge out this weird situation we find ourselves in, the dichotomy between the stocks that we like and the overall market outlook.
Raji, great explanation. Is that to me is very clear. Do any of you guys have questions on this, or are there other elements to this that you want explored further? Yeah, what's up, John?
So we're about a couple of months away from an election. How do you weight politics in this equation of yours? And if so, how?
We do. It's definitely a risk. Regardless of your political leanings, over the first 3 years of his administration, the market did like the president very much. We saw a consistent trend where anything that happened that was good for President Trump caused the market to go up. Events that were negative for him or his administration would cause the market to go down. Again, that's not political analysis. It's just noticing, the market's preference on this. There certainly are issues like regulation and tax rates that are going to be decided this November. It's one of the things that does concern us at the moment, and we're watching it carefully. And it is part of our concern regarding the market, and one of the reasons why we are as heavily hedged as we are. Raji, is there anything you want to add to that?
Yeah, I actually think, John, that's a really great question, because it goes exactly to what we were just discussing. We have an election coming up. I don't want to make a political opinion, but the general consensus is if the Democrats win, they'll raise taxes and they'll re-regulate the economy. Let's just take that as face value. That's bad for the market. So we're at an election, which is a binary event. If the Republicans win, it's good. If the Democrats win, it's bad. Let's just take that as the base case. The market should be discounting that. As we look to invest into the election, we want a discount. If I buy a house and the backyard is a disaster, I want a discount when I buy the house. If I'm buying a house that needs a lot of rework or fixing, I want that. If I want to buy a house and maybe a big tornado is heading towards me, I want something. So the problem with the market, and this is a great example, John, is we've got this major event happening. In normal times, you would expect the market, if you remember the Trump Hillary election, the Clinton election, the market went down into that election. It looked like Hillary was going to win, and we were negative on the year. Trump won in that entire recovery in 2000. Was it 16, 15?
16.
Was in November and December. That's not happening now. So some people will attempt to say, well, I know why, and I'm going to explain it, and I'm going to position my portfolio. I just think that's very arrogant for people to assume, and we've taken a different approach. So your question is a great question because it highlights how we're thinking about it. It's one of the major risks in the market, along with where coronavirus is going to go in, the pace of opening, what happens when we bring back people for school, a whole host of stuff. And yet we're not getting a discount for it. There's a major uncertainty and there's no better entry point into stocks because of it. In fact, they've gone up into this uncertainty. That's not a great place to be. Now, history shows us the market can ignore these problem signs until they really destroy a lot of capital. If people remember this year, as an example, cases started spiking very quickly. And as early as I think the market topped out February 19th, we had that first 2 weeks of February where caseloads of COVID were increasing and people were talking about potential shutdowns and the market ignored it. And then all of a sudden it became the most important issue and there was an inflection point. So it's hard to know when that's happening, but the election is a huge uncertainty and we're not being offered any kind of extra to buy into a more uncertain environment. That is a problem across the board in terms of Fed policy, in terms of COVID. And that's why I say the overall S&P is very uninteresting here. We're not, they say buy when there's blood in the street. That's because things are cheap. You buy airline stocks after a crash, you buy insurance companies after a hurricane. We're not getting discount valuations here. We're not getting deals, despite which should be a very deal-rich environment. So how do we handle that? We do a spread trade. We basically try and hedge out that disconnect. I don't know if that answers the question, John, but it's a great question.
Actually, Raji, I think it was a great answer. And the only thing that I would add, I agree with everything you just said. The only thing that I'd add is it's very easy for people to look at a situation like this and say, well, this is terrible. There's no opportunity. The market isn't pricing in this uncertainty. And the point that Raji and I are trying to make is mispricings represent an opportunity. The fact that the market isn't pricing in these risks mean we can take advantage of it by shorting that and being long the aspects of the market or the companies that are cheap or recovering or performing very well in this environment. So while we see mispricing, please don't interpret that as a bad thing, a negative thing, a problem. It's merely an opportunity that we can use to take advantage of it.
Think of it this way. There's an old saying on Wall Street that Gary and I refer to in some of our letters and I think of oftenly. It's called picking up pennies in front of a steamroller. You're making money and then the steamroller comes and flattens you. So that's what the market feels like today, the overall market. I mean, how much more multiple and valuation expansion can we have given all these risks out there and things, uncertainty, but there's a lot of momentum in the market because stocks are going up and there's, the industry is a weird dynamic short term. There's a lot of fear of missing out. And it's not just fear, it's business risk of missing out. Funds that underperform have to catch up. So people are scrambling, they've underperformed and they're trying to, capture this last bit maybe of momentum. And they are, in our opinion, picking up pennies in front of a oncoming steam.
Go ahead, John.
So one of my jobs in my life was to be a futurist. And about 15 years ago, I remember sitting in a room, maybe it's more than 15 years ago, and predicting that in my lifetime, the Dow would hit 25 to 30,000. At that point in time, that wasn't long after we had years and years and years of the Dow never crossing over 8,000. And I was out there saying it's going to go over 25. I wish I'd invested accordingly, but I hadn't. So the question to you guys is, if if you were looking at the Dow as kind of one of the universal measures, I know that in the finance industry, you guys don't see the Dow that way, but in most of America, they kind of do. You know, Dow goes up, everything is good. Do you see that there is a ceiling to the Dow?
I'm going to go with a very strong, I don't know. It's difficult to predict I mean, you're talking about, first of all, it's a price weighted index, which means it's not cap weighted. The Dow is based off of price, and it's just over 30 companies. I don't have a prediction on what's going to happen long term with those particular companies or the prices of those companies. Also, John, remember, if any of those companies has a stock split, it reduces their impact on the index. And that's the kind of thing that has no economic impact, but will affect the index.
John, can I, let me answer that a different way. Why are you asking that? What does that lead you towards?
The market is a reflection of how we feel about the future. Because fundamentally, it's a simple formula. One idiot completely convinced that a stock has nowhere to go up, nowhere but down, has to find another idiot equally convinced that it has nowhere to go but up. That's not a calculation, that's an impression, that's a response basically about how we feel. If you go back historically, every time there was a major global event, like for example, the Bolshevik Revolution, there was a market crash. Why would the market have crashed when the Bolsheviks had a revolution? Because throughout most of the world, people saw that as the end of capitalism, the beginning of something new. The Cuban Missile Crisis, the stocks went down, everything went terrible. Why? Because we were all going to die. What was the point of investing? So we look for things that seem to say to us there is some certainty or at least a direction. And I think the stock market, again, maybe exhibited as Dow, has kind of, so it's circular logic. You know, if the stock market's going up, that drives people to be more positive. So it's a valuable indicator of how people feel, though it may not be a meaningful metric.
Yes, most of the time. Most of the time, that's right. That's exactly, that is the dilemma today. That price discovery mechanism is being broken down because you have a large buyer in the credit market, and we'll discuss that, but you have a large buyer in the credit market that's not making that assessment. They're just buying. And the reason they're buying is they want to stabilize the market. You described two agents in a market which are trying to, do risk and valuation based on some outlook of the world. But now we've got this giant 800-pound gorilla in the market, and they don't care about that. In fact, they want to buy the irrationality. They're trying to fix that. So if you go into the credit market today, given what's going on in the world, you would expect yields on junk bond quite high, not lower than they were before pre-COVID, not lower than when they were when we had 30 million people unemployed, lower where they were when we have the uncertainty about whether the unemployment benefits would go. So John, that's exactly the problem. Right now, we have a breakdown of system. So we can't really, 90% of the time, we can rely on what you just said. In times of crisis, the Fed becomes the gorilla in the room. And, in terms of predicting the market, predict what the Fed's going to do. I mean, every time the market's gone down, they've expanded their balance sheet in QE, and that's turned the market around. It's much like giving a junkie drugs and then trying to take them away. At some point you're going to kill the patient. It's very hard to do. And that's the problem we have. I mean, if the Fed moves away and we go to what you just described in that terms of a market mechanism, then I think we would be right that the market doesn't assess the risks that are out there, and it would go much. Today,
Raji,
that's not there because the Fed.
Raji, you cut out for a second. Go back one sentence.
I said the market's level reflects the Fed, not the interaction of agents on the buy and sell side like it normally does. And that's a great point, John, and I think that's the dilemma that most investors have today.
Also, John, one thing that we'd add to that is not only is the Fed a price insensitive buyer, like Raji mentioned, but going to your example where you have one person who thinks a particular stock or the market is nowhere to go but up, and another person who thinks it is nowhere to go but down, those people have a certain amount of capital to deal with, and there are players in the market with large amounts of capital, but at some point, they're limited in the exposure they can take. The Federal Reserve can print trillions of dollars and go buy more. And as Raji said, they are not valuation constrained, and they're also not capital constrained. They can print an unlimited number of dollars and just go buy things.
And just also remember today, since '08, corporate leverage, personal leverage, government leverage has grown tremendously. I mean, 08, 09 was the leverage problem. We've just got more levered across the board, globally, in companies and individuals. So today, when the Fed stabilizes the credit market, that's the connection to the equity market. They're forcing institutions into higher yielding instruments to take risk because they can't make money in the lower risk areas of the market, but they're also stabilizing a highly levered system. And in doing so, they've protected it. So companies can issue, refinance, banks can access commercial paper market. In 08, 09, when that started to break down, we were losing 500,000 jobs a week, and we were heading towards disaster. So they know the playbook, and that's really what's happened here. And because of leverage in the system today, it's actually quite an effective policy. The question is whether it's sustainable. And that, you're dealing with sort of, now you get into foreign currency markets and debt to national GDP and that kind of stuff. But we're in a complex world right now, and there's a lot of problems, and there's a lot of leverage. And in many ways, it's a house of cards, and we have to be careful and cognizant of that.
So just a quick follow-up question, as they say in Washington, D.C. So we got leverage, a lot of leverage, lots of leverage, which is what we had in 1929, which is what caused the crash of 1907, which caused every time in history when we had a crash, people were encouraged to buy things that they couldn't afford on the assumption that they would eventually be worth enough for them to pay it back. What is the price? What is the cost of this stabilization, long-term damage to all of us?
Go ahead, Raji.
We have examples of that. Let's look at Greece. Let's look at Argentina. Venezuela is more, I think, about political problems, social. I guess most of Europe is. The problem is the dollar. At some point, there are many problems. First of all, today we have the world reserve currency, and we benefit from the fact that the rest of the world looks much worse than us. So we're able to borrow at much lower rates despite that, and we get this kind of free mechanism. But what happened, if you think about our debt structure, today about 25% of the budget goes towards interest, right? So these are very simple numbers, 4 trillion in spend or something like that, about a quarter of that on defense, a quarter of that on entitlements, a quarter of that on running the government, a quarter of that on interest, at very low interest rates. At some point you borrow so much, the credit risk becomes an issue and people want more money, or the environment normalizes. A good economy might not be great for the market. It would send interest rates up, and imagine what that does to the deficit and then the national debt. No one knows where the trigger is on of debt to national GDP as sort of the disaster zone. Japan's been running over 200% for many years. Greece imploded at 170 or 180%. So, the risks are twofold. One is, we're now, the U.S. economy now is exposed to rising rates. We're effectively, as an economy, short rates on a federal government level. Secondly, we have, if you take this to an extreme, you can have hyperinflation in countries that have over-levered and overspent and then try and print their money way out of it. That's why gold's doing so well this year, and that's why Bitcoin has started to do so well this year. People are worried about the dollar and the coming devaluation of it with all this money printing and liquidity. So there's a lot of problems here. It's a time bomb. You're basically kicking the can down the road and hoping that somehow the Fed can, either unravel its balance sheet very slowly and not scare the market, or we can, continue to borrow it at slow rates and not disrupt everything. But it is like sleeping on a time bomb and not knowing when it's going to go off. And it gets worse in different macro environments. Europe never reforms, but back in, I don't remember which year was it, Gary, when Italian bonds hit kind of
2014.
Government bonds hit 6-7%. All of a sudden they talked about reforming the pension funds, and all of a sudden they talked about, breaking the unions in Europe. So the credit market is the risk here. It could change a lot of things, and it's something to be concerned about. Near term, I don't think we have that kind of risk here. We are the reserve currency. We continue to do this for quite a bit of time before it becomes a catastrophe.
That's a good answer. Anyone else have follow-up questions? All right, well then, thank you so much for being on the call. Raji, thanks for your insight on all of this, and we'll look forward to the next call. Take care, everyone.
Gary, will you send a video to us, because Raj made some good points and there were other good points made.
Absolutely, Jim. I'm going to post the video to the website. It should be up in a day or two, and we'll have it out.
Perfect, thank you. Good seeing everyone.
Thank you. Bye, everyone.
Bye-bye.